Want to know why ordinary American families can barely survive financially in 2026? Forget complicated economic theories. Just remember one simple date, March 23rd, 2006. That's the day everything changed. And most people have no idea it even happened. On this exact day, the Federal Reserve quietly stopped sharing something called M3 money data with the public. They released a boring official statement saying this information was unuseful anymore and cost too much money to collect. The news barely covered it. Regular people didn't even notice. But here is the truth. This was the moment the powerful decided to turn off the lights so they could rob us blind. They didn't hide this chart because it was worthless. They hid it because it was the only number that showed us what was really going on. Let me break down what money supply actually means. The Fed divides money into different levels. One is the simplest, that's the cash you carry and the money sitting in your checking account. This is your everyday spending money. M2 goes deeper. It includes everything in M1, plus your savings accounts and money market accounts. Think of this as your household wealth. But M3? That was the master key. It showed everything in M2, plus the massive amounts of money controlled by big institutions, huge bank deposits, institutional investment funds, and complex financial agreements called repos. M3 revealed how much money was really moving through the shadow banking system. It tracked the wealth of the ultra-rich, the hedge funds, and massive sovereign wealth funds. When the Fed canceled M3, they basically told us, you can see how much money average people have through M2, but you can't see how much money the big banks are creating through M3. The timing wasn't random. Back in 2006, the housing market was inflating like a balloon about to pop. If regular people could have seen the M3 numbers, they would then notice the money supply was exploding at a terrifying speed, a clear warning sign that a massive crash was coming. By hiding this information, the Fed let the bubble grow until it finally burst in 2008, destroying millions of lives. Now jump to 2026, we're watching the same story play out again, but this time it's even scarier. Over the past year, the Federal Reserve has started delaying M2 data and constantly changing the numbers. They switch from weekly reports to monthly reports, and they often go back and change the figures by hundreds of billions of dollars. Why now? Because the entire system has broken down. Here's how it's supposed to work. When the Fed creates $1, banks are supposed to lend it out, creating about $10 in the economy through loans. That's normal economic growth, but today, everything's backwards. The Fed is printing trillions of dollars, but banks aren't lending it to businesses or people. They're hoarding it. The velocity of money, how fast a dollar moves from person to person, has dropped to levels we haven't seen since the Great Depression. The money isn't reaching your local coffee shop or construction companies. Instead, it's stuck in government facilities like the reverse repo program and treasury accounts. It's trapped in the government's financial plumbing. This creates something called bifurcated inflation. Since the new money stays locked in the financial world, we get asset inflation, stocks and houses shoot up in price. But we also get economic stagnation. Your wages stay flat and growth stops. However, this money printing still hurts you. Even without a pay raise, your dollars lose value because the total number of dollars in existence, which you can't even see anymore, is skyrocketing. The Fed knows that if they published real, honest M3 data today, it would look like a rocket taking off. It would prove they're printing money so fast that hyperinflation is guaranteed, so they simply stop showing us the chart. Instead, they tell you to watch something called Core PCE, a rigged inflation measure that deliberately excludes food and energy costs. The two things you actually need to stay alive. They're lying to us with carefully designed numbers while hiding the real data. This statistical cover-up is what dying currency systems always do. When the Soviet Union's economy started collapsing in the 1980s, they didn't fix their problems. They just stopped publishing harvest reports. When Turkey's inflation spiraled out of control in the 2020s, they fired the person in charge of statistics. The U.S. is now walking down that exact same path. Hiding money supply data is basically a confession. The central bank is saying, we can't defend what we're doing, so we'll just hide it from you. But while they can hide digital numbers on charts, they can't hide physical reality. They can't hide the price you pay for eggs at the grocery store. They can't hide what you spend on gas. The real inflation numbers are right there on your credit card statement every single time you buy something. The gap between the official story, inflation, is only 3%, and your actual experience, inflation, feels more like 15%, exists because they re-suppressing the real data. They re-gambling that if you can't point to the specific chart proving they re-destroying the currency, you'll blame greedy corporations or supply chain problems instead of the money printer. This information blackout forces smart investors to fly completely blind. How can you figure out what a stock or bond is really worth if you don't know how many dollars exist in circulation? If the bottom number in the equation, the money supply, is hidden, then any valuation is just a wild guess. This is pushing investors toward hard assets. Gold doesn't need a government report to prove its supply. Gold increases by roughly 1.5% each year, controlled by physics and geology, not politicians. Bitcoin doesn't need a Federal Reserve announcement. Anyone with a laptop can verify its supply through code. People are moving to these assets not just for profits, but for truth. Investors are abandoning the opaque dollar system for transparent assets. They're rejecting a game where the referee hides the scoreboard. The Fed stopped publishing the chart because that chart was evidence of their crime. In the next part, I'll show you the specific tricks they're reusing to hide where this new money comes from. A scheme where the Treasury Department bypasses the Fed completely to pump money directly into the stock market. The disappearance of M3 was just the beginning of a much bigger magic trick, the takeover of money creation by the United States Treasury. For 100 years, the roles were clear. The Federal Reserve controlled the money supply, the gas pedal. The Treasury Department controlled the budget, the steering wheel. The Fed was supposed to be independent, protected from political pressure from the White House, but after 2020, and especially speeding up through 2025 and 2026, this protective wall has been completely destroyed. We've entered the age of fiscal dominance, where the Treasury Department, run by politicians, has basically stolen control of the money printer from the central bank. They've created shadow quantitative easing, a system that injects trillions of dollars into financial markets without a single Federal Reserve vote and without a single news headline admitting that money is being printed. The main tool for this deception is something called the Treasury General Account, or TGA. Think of the TGA as the government's checking account at the Fed. When the government collects your taxes or sells bonds, money leaves the banking system and goes into the TGA. This removes money from the economy. When the government pays its bills, money flows out of the TGA and into the economy. This adds money to the system. Historically, the TGA was boring. It maintained a steady balance. But starting in 2023, Treasury Secretary Janet Yellen transformed this checking account into a weaponized liquidity cannon. While Fed Chair Jerome Powell was publicly raising interest rates and claiming to do quantitative tightening to fight inflation, basically trying to drain water from the bathtub, Yellen was simultaneously draining the TGA to pour water right back in. She strategically released hundreds of billions of dollars from the TGA into the banking system to cancel out the Fed's tightening. It was a classic good cop, bad cop routine. Powell played bad cop, telling everyone, "We must suffer to defeat inflation." Yellen played good cop, secretly funneling cash to the markets to stop stocks from crashing. The end result? Net liquidity stayed neutral. The money the Fed removed got replaced by the money the Treasury injected. The entire inflation fight was theater. The brakes were smoking, but the gas pedal was pressed to the floor. But the TGA trick was nothing compared to the reverse repo drain. We touched on this before, but you need to understand this was a deliberate choice by the Treasury. The reverse repo facility was holding over $2.5 trillion in parked cash. Money. That money market fund stored at the Fed because they had nowhere better to put it. This money was completely dead. It wasn't moving through the economy. Yellen realized that if she could get this money flowing, she could stimulate the economy without the Fed printing a single new dollar. How'd she pull it off? She flooded the market with treasury bills, short-term government debt that paid slightly better interest than the reverse repo facility. Money market funds, making the rational choice, pulled their trillions out of the reverse repo, dead money, and bought treasury bills instead. When they bought those T-bills, the cash went to the government, which immediately spent it into the economy, live money. This was sterilized stimulus. It unleashed $2.5 trillion of inflationary power into the system during 2024 and 2025, completely wiping out the deflationary impact of high interest rates. The Fed stopped publishing the charts that would make this obvious to regular people, leaving only complex technical reports that only Wall Street analysts bother reading. Then came the Bank Term Funding Program, or BTFP, the ultimate, this isn't money printing scheme. When Silicon Valley Bank collapsed in March 2023, the banking system was bankrupt. Banks were sitting on massive losses. If the Fed had launched QE4, buying bonds, it would have caused panic about hyperinflation. So they invented a new acronym, BTFP. Instead of buying the bonds directly, they made loans against those bonds at full value. The economic result is identical. The Fed creates fresh cash and gives it to banks, but the accounting looks different. It's recorded as a loan, not a purchase. Because it's classified as a loan, they can claim the balance sheet isn't permanently expanding, it's just word games. They pumped hundreds of billions of dollars to keep zombie banks alive, labeled it a temporary liquidity facility, and the media repeated the talking point without questioning it. This program essentially put a safety net under the stock market. Investors realized the Fed put had evolved. It wasn't just that the Fed would lower rates if stocks fell. Now the Fed would literally invent entirely new accounting categories to prevent any serious financial losses. This brings us to the net liquidity formula, the secret chart that hedge funds trade on while regular investors watch cable news. Net liquidity equals Fed balance sheet minus TGA minus reverse repo. If you put the S&P 500 chart next to the net liquidity chart, they're basically identical. The stock market isn't tracking corporate earnings. It's not tracking innovation. It's not tracking the actual economy. It's tracking the rise and fall of this manipulated liquidity. When Yellen drains the reverse repo, stocks climb. When Powell shrinks the balance sheet, stocks wobble. The entire bull market of the mid-2020s is a monetary mirage created by the Treasury's hidden plumbing. It's a nominal bull market, not a real one. Sure, the Dow is up 20%, but the dollars you use to buy the Dow have lost 20% of their purchasing power. You're running on a treadmill. It feels like you're moving forward, but you're actually standing still while the ground crumbles beneath your feet. The danger of this fiscal dominance is that it destroys the natural feedback mechanism. In the old days, if the government spent too much, bond yields would spike, the economy would slow down, and politicians would be forced to cut spending. Today, the Treasury manipulates the yield curve by issuing short-term bills instead of long-term bonds to keep interest costs artificially low. They're financing long-term obligations with short-term credit cards. This works temporarily until the refinancing wall crashes down. In 2026, trillions of dollars of this short-term debt is coming due. Because they played games with debt issuance to drain the reverse repo, they've shortened the average maturity of U.S. debt to historic lows. The U.S. government now basically operates like someone with an adjustable rate mortgage. Every time the Fed delays cutting rates, the interest expense on the national debt jumps higher. We're borrowing money just to pay interest on money we previously borrowed to pay interest. This is textbook Ponzi finance. Hemeninsky, the famous economist, identified 3 stages of finance. First, hedge finance. You can pay both principal and interest from actual cash flow. Second, speculative finance. You can pay interest, but you have to refinance the principal. Third, Ponzi finance. You can't pay interest or principal. You must borrow just to cover the interest payments. The United States government is now firmly in stage 3. The shadow liquidity operations, the TGA drain, the reverse repo drain, the BTFP are just desperate scrambling by a Ponzi operator trying to find fresh cash to keep the scheme alive for one more month. This explains why American voters feel so confused. The government points to GDP numbers and says, look, the economy is growing at 3%. But voters look at their bank accounts and see them shrinking. Why? Because GDP measures spending, not actual wealth. If the government borrows $2 trillion and builds a bridge to nowhere, GDP increases by $2 trillion. But the nation's real wealth has decreased because now we have debt to repay and a useless bridge. The shadow liquidity pumps inflate the GDP number spending while destroying the balance sheet, wealth. It's like burning your furniture to heat your house. The thermometer says the house is warm, GDP is up, but you're running out of furniture, capital depletion. The Fed stopped publishing the money supply chart because it would expose that we re-burning the furniture at record speed. They do and want you to see that our growth is just smoke from the fire consuming your future. In the final section, I'll discuss where this inevitably leads, the crack-up boom. This is the phase where the public finally realizes that liquidity is infinite but actual goods are limited. It's the moment when money starts moving at lightning speed, not because the economy is healthy, but because nobody wants to hold the currency anymore. I'll show you how to position yourself for when shadow liquidity floods out of the financial sector and spills into grocery stores, transforming asset inflation into full-blown hyperinflation. The endgame of the Federal Reserve's data suppression and the Treasury shadow stimulus is something Austrian economist Ludwig von Mises called the crack-up boom. Most people imagine hyperinflation as prices gradually climbing higher until they become annoying. But the crack-up boom is completely different. It's a psychological shift. It happens when regular people realize that inflation isn't temporary, it's not transitory, and it's not accidental. It's the moment the public understands that the government has no intention and no mathematical ability to stop printing money. When this realization hits, demand for the currency collapses. People stop saving. They rush to convert their dying currency into anything physical: houses, cars, gold, appliances, canned food. The velocity of money shoots straight up. The economy looks like it's booming because sales are exploding and the stock market is hitting new highs in nominal terms. But in reality, people are rejecting the currency. We're currently standing right on the edge of this transition. The trigger for this final phase will likely be what I call the spillover event. For the past 15 years, the Fed has successfully trapped inflation in asset markets, stocks, bonds, real estate. They printed trillions, but that money went to wealthy people who bought assets. This didn't immediately triple the price of milk, so the Fed claimed there was no inflation. But the shadow liquidity mechanisms we discussed, the TGA drain, the BTFP, have filled the reservoir to the absolute top. The dam is breaking. As baby boomers retire and need to sell their inflated stocks to pay for living expenses, food, healthcare, nursing homes, they're converting asset inflation into consumer price inflation. They're pulling money out of the S&P 500 and putting it into grocery stores. This is the reverse wealth effect. The trillions of dollars trapped in the financial casino are leaking into the real economy. Since there are more dollars chasing the same amount of actual goods and services, the cost of living explodes. We're shifting from asset price inflation, good for the wealthy, to stagflationary, hyperinflation, devastating for everyone. This environment demands a completely different survival strategy than what business schools teach. In a normal economy, you save cash to buy assets later. In a crack-up boom, cash is garbage. Holding significant fiat currency guarantees you'll lose money. Your strategy must shift to just-in-time liquidity. Keep only enough cash to cover your immediate bills, 1 to 3 months of expenses. Any extra money must be immediately converted into a store of value. It's a game of hot potato. The second your paycheck arrives, you must convert it. Into what? First, the hard monies, gold and Bitcoin. We've established this. They're your exit buttons, but in a crack-up boom, their volatility changes completely. They don't just gradually increase. They gap up violently. You wake up and gold jumped $200 overnight. You wake up and Bitcoin is up 10%. You can't wait for a dip. The dip never comes because the currency is falling faster than these assets can correct. Second, durable goods. This is the most underrated hedge. In a high-inflation environment, a pantry full of food, a garage full of tools, and a closet full of clothes become financial assets. Buying a year's worth of toothpaste today at $400 is a risk-free return if the price hits $800 next year. That's a 100% tax-free gain. This is personal inventory management. You become your own central bank of physical goods. Third, fixed-rate debt. If you locked in a 3% mortgage, you're winning. Inflation is paying off your loan for you. Don't pay it off early. Let the bank absorb the loss. But avoid variable rate debt, credit cards, home equity lines of credit, like the plague. In a crack-up boom, interest rates can spike to 20% overnight as banks panic. That will bankrupt you instantly. But the most critical adjustment is mental flexibility. The crack-up boom creates massive distortions in relative prices. One day used cars are expensive. The next day they crash because nobody can afford gas. One day tech stocks are soaring. The next they collapse because price-to-earnings ratios become meaningless. You must stop thinking in dollar amounts and start thinking in purchasing power. Don't ask how much is my house worth. Ask how many ounces of gold is my house worth? When you view the world through this lens, you realize most Americans are getting poorer even as their 401 kiloseconds hit record highs. The S&P 500 priced in gold has fallen over the last 5 years. Average wages priced in hamburgers have declined. The money illusion blinds the masses, but realistic people see the decay. The cancellation of M3 data was the government removing the smoke detector before starting the fire. They knew that if the public saw the true scale of money creation, the crack-up boom would have started in 2008 by hiding the data. They bought 18 years of extend and pretend, but the math has finally caught up. The deficits are too enormous to fund with taxes. The interest payments are too massive to fund with borrowing. The only option left is the printing press. And because they can't admit this, they'll gaslight you until the very end. They'll blame supply chains. They'll blame Putin. They'll blame speculators. They'll blame climate change. They'll blame absolutely everything except the chart they stopped publishing. The Great Reset isn't some conspiracy theory from Davos meetings. It's the mathematical reset of a system that has run out of road. It's the devaluation of liabilities, currency, to clear the deck for a new system. This transition will be chaotic. It will be frightening. Wealth flows from the uninformed, who hold cash and bonds, to the informed, who hold real assets. The 0 hour is approaching. The shadow market is freezing up. The money supply is exploding. All the warning signs are flashing. You don't need the Fed's permission to see the truth. Just look at your grocery bill, look at your savings, then make the decision to exit the burning theater while there's still time. The chart is gone, but the reality is staring you right in the face.